Hey everybody, Marty Mazzoy, good evening. It's the 9th of November 2016, day after the election, and what is truly, or was truly an unprecedented market reaction. Last video you got from me was late last night, and I shot that, or recorded that, amid a 8 to 900 point, I think, actually, when I actually was posting it, it was down that far. I think when I made my presentation, the Dow was down about 700 points in terms of Dow future. So we got close to 900 points if we didn't actually hit it at some point last night, which was consistent with what all of the narratives were, including mine to some degree, about what would happen if Trump were to win. What was inconsistent is that the market rallied early this morning actually, when I took a look close to the open, the Dow future was down 200, 250 points, and then quickly after the open, it came bounding back. About 1,100 point plus move from the bottom last night. That is absolutely a phenomenal move in any market and for any index. So I want to talk a little bit to you this evening about what we talked about last night, bring you up to speed where we sit today. The chart in front of you is the the daily one-year chart for the S&P 500. I've been spending a lot of time on the 200-day moving average, and you can see just 2 or 3 days ago we hit that and just bounced firmly right off of that. That's a very good sign and confirms the upward trend in stocks, although last night Dow futures, and this is the S&P, but S&P futures would have done the same thing, brought us notably below the 200-day moving average. It looks something like the Brexit event. And again, as you can see now, we shot through that. I would say, based on this action, just spending a little bit of time below the 2100, that support level indeed held. And when I looked at volume at price, another chart that I track, a lot of money was buying stocks right in there. The market did come back up, as you can see, that 2120 more than held, and now we're up here in this open space that suggests that there could be some momentum up above that red line, which would be the all-time high for the S&P. So we shall see. The slope still looks good in the 200-day moving average, so without question, we are still firmly in a bull market, still firmly in an uptrend. So last night, I shared with you the Fibonacci retracement level, so I just thought I'd look at that really quickly here one more time. I want to trace it back from the February low on the S&P. Last night we did it on the Dow. You come up to the recent high. You can see that the Brexit low came right at a very popular retracement level for technicians, and that's 50%, and it held certainly on a closing basis. Came back up. We just tested that 23.6 for a few days, and we came back off of that. So some would say that 2100 level really is where we see some support. I suggested last night that doing 30, 50, 60% retracements are actually the norm. It'd be unusual if we don't come down and at least test this line. We did in the futures market last night, but it would be unusual if we didn't during the regular trading day as well. Right now, the market seems to have some momentum underneath it. When I take that retracement and move it to the Brexit low, you can see that level that we hit a few days ago was right at that 50%, 2092, that 50% retracement level from the Brexit low. So those Fibonacci levels seem to be good telling indicators in terms of where technicians, chart watchers, and traders are jumping back into the market on the sell-offs. Because again, I'll say it again, when you're in an uptrend, you want to buy the dips against support if you're a trader. So last night I talked a bit about sentiment again. That's been a topic of mine for quite some time now because it's been so low. Going into Brexit, we were talking about declining sentiment. This is the American Association of Individual Investors bullish sentiment, and it's done on a weekly basis. And it was in the low 20s, as you can see. This was the week before the Brexit event. Here we were last week, which was the last reading, next one I'll get tomorrow, at 23.6. So we're actually even more bearish in terms of the number of folks who said they're actually bullish for the next 6 months than we were here. Another indicator that suggested that the sentiment was waning is the short interest. This is for the New York Stock Exchange, the percentage of float, meaning stocks that are out there being traded. This is the number of shares, or the percentage of those shares that are being shorted. You can see there's been a steady increase and a pretty good spike in October, so the second 2 weeks in October. So clearly, sophisticated investors were betting on a decline in stocks, Here is the Futures Trading Commission Commitment of Traders report, and this, well, that's what this yellow line is for S&P 500 futures. Folks who trade those futures contracts are net short, and this is the last reading as of last week, by 20 some odd thousand contracts, and that is something that that is very short. And you can see recently we were at very high levels relative to where we've been, but it's more short than it was back here right before the Brexit event as well. So like I said yesterday, folks, it's tough for the market to fall apart in a big way when sentiment is so negative. Why? Because when we have individual investors and we have institutional investors who are net short, that means there's just a lot of holders of stocks, or who would otherwise be holders of stocks, who are feeling fearful, and therefore they're not holding stocks. They're holding a lot of cash, and the big positions are concentrated with some big traders who tend to be pretty smart investors. So when you can find the sentiment strongly on one side of the boat, as I've said here ad nauseum, you want to be on the other side of that boat. Okay, so as it relates to mutual funds, cash on fund fund portfolios. This is the Merrill Lynch Bank of America monthly survey. This is the last one. You can see we have exceeded highs that we haven't seen since 2001. So mutual funds have been relatively cautious in holding lots of cash. Another indicator of that is their risk and liquidity index, which takes into account the riskiness of the assets that they're holding, the duration or the time frames, plus the cash. And you can see we're at relatively low levels. When we hit these levels here before during this expansion, these were levels that the market bounced off of quite nicely. Here we are with U.S. equities. The blue line below the black tells it we're underexposed in terms of the mutual funds to U.S. stocks. And you can see what the trajectory has been for U.S. equities. Wow. Fund managers are in an underexposed position. Here's a couple of bars to the upside, and you can see the market trailed a bit. So right now, that's also a bullish indicator. It's one that says that mutual funds have been cautious. Here we are with equities relative to bonds and cash. You can see that's at a low level that happens to be getting back and threatening these levels that were actually good buying opportunities in the past. And then here's the cash level. An easy way to look at it. Mutual funds are hugely overweight cash relative to history. Global equities overall, very underweight. So a nice setup to be in stocks. One more. This is global equities. These bars to the upside suggest an overweighting, but you can see relative to recent history, pretty low these days. And when we've had levels this low, the market has tended to do pretty well. So again, another indicator, at least from the mutual fund world, that suggests that stocks are poised, or positioning is poised to push stocks higher going forward. Okay, so the bond market had a fit today. Yields soared relative to what we've seen in quite some time. This is the TLT, which tracks the 20-year Treasury bond. You can see it just got creamed today as interest rates went up. So why would interest rates go up today? I told you last night that Fed funds futures odds had dropped precipitously when it became clear that Donald Trump was going to win the presidency. Well, they bounced back today. Trump, in his acceptance speech and other commentary leading up to the election, has talked about investment, government investment, infrastructure investment. Now, that's going to require expanding the budget deficit, which means issuing a greater supply of Treasury bonds. And when you bring new supply to market against a demand that may or may not be there relative to where it's been when we've had a lower supply, interest rates are going to have to get bid up to sell those bonds. So the bond market reacted perhaps to that. Plus, if we're indeed moving into that later phase of the cycle, which is somewhat characterized by business investment and infrastructure investment, that tends to be the inflationary phase of the cycle, and a phase where the Fed gets active in terms of tightening monetary policy. And you want to be in assets that tend to reflect higher inflation. Bonds would not be one of those assets. We don't own bonds in any portfolios currently because of the interest rate setup and the expectation that the next major move in bond rates is going to be higher, but we've been sitting there for an awfully long time, and there's been several head fakes. We'll see if this one lasts. Utilities would be another thing to avoid. Very interest rate sensitive. People tend to buy them for the dividend yield. So when other opportunities present themselves because rates are rising, utilities can get absolutely creamed. And based on what I'm seeing in the economy, what I've been reporting to you for months, I haven't been expecting the kind of economic scenario that would suggest we need to get defensive and be buying utilities, particularly at today's valuations. And today's move, although it's just a one-day move, which does not a trend make, though, can tell you just a monster sell-off from what utilities had been doing leading up to the election. Okay, emerging markets. Big hit today in emerging markets. They did come off of where they were when I looked at them here, so, but still a notable miss there, or a notable decline from the opening. Why would that be? Well, I listened to a couple of commentaries I don't necessarily agree with. One of the commentaries was the prospects for a stronger dollar hitting emerging markets. I get that. If interest rates go up and the U.S. economy begins picking up, well, that could lead to a stronger dollar. But the whole inflationary cycle really, by definition, means a weaker dollar. So I really don't see the dollar, soaring through the roof. It was up over 1% today. So today was a very big day for the dollar. I'm skeptical that we're going to see a great deal of capital outflow. I do think it was probably profit taking. Far and away, emerging markets were the best part of our portfolio so far this year. And there was definitely some rotation and I think some fear. But I think it may be more about the rhetoric around trade and immigration and so forth. That would be very destructive to our international relationships, as I've preached here a lot. And we're going to have to wait to see if that rhetoric has any substance behind it. It won't surprise me to see a pretty nice bounce tonight off of a bounce in America, in global markets, even emerging markets, but that remains to be seen. I still like them as an important part of portfolios, although they are one of our lower allocations simply because they're so volatile. What worked today tremendously was financials. Now, financials carries the heaviest weighting in just about all of our portfolios, partly because we've been expecting interest rates to start picking up. And they're really, really cheap, and it's time for them to begin doing well. They did better today than they have over the last 2 years. They're up about 4.5%. And valuations, I'll say it again, are just amazingly inexpensive. Why they rallied so hard today, part of it was the potential for higher rates, but also it was the potential for a Donald Trump with a Republican-controlled Congress to really roll back some of these burdensome financial reforms, or regulations, I should say. Good or bad, right or wrong, that would be something that would be very positive for financial stocks, hence the big move today. I showed you this a couple of weeks ago. This is my chart of government spending. This is federal government construction spending. I can pick up state and local here. You can see leading up to the last 3 recessions, we saw a nice upward slope there. The government was making big contributions to the U.S. GDP. Has not been the case of late. In that article 2 weeks ago, I talked about the fact I saw bipartisan support for infrastructure spending going forward, regardless of who won. Trump is out there talking right now about big moves in infrastructure, and so we're talking paving roads, revamping airports, the whole gamut. It's all talk right now. It does have to pass through the channels and through the process, but probably has a high likelihood that something's going to happen. That could be very bullish for stocks, certainly for sectors that we've been talking about lately, like industrials and materials and so on. Copper today soared higher. Copper, of course, is one of the most widely used, if not the most widely used industrial metal. It would make sense that copper would get a big bounce today off the Trump news. I mentioned materials. Material stocks had a very, very strong day today. Obviously, we would need materials to do the infrastructure and other things, and it's also a late cycle play, in my view, mid to late cycle play. Industrials, somebody's got to move the earth. Industrial stocks had a good day today as well. And that's actually all of my slides. So folks, to kind of wrap it up, today was largely about positioning. So I know I finished with the prospects for what at least the noise, what the commentary and what the promises would be with the prospects in terms of where it is bullish, and the things I just showed you where it's bearish, and things like utilities. And I didn't show you a chart on staples. They would be thrown in that camp. Positioning, though, I'll say it again, huge short interest or an increase in short interest big hedges. I mentioned in an earlier blog today that Mark Cuban had said he put on the biggest hedge of his life in case Trump wins. Well, what happens is you put in those big positions, you go heavily short. If the market goes against you, you have to cover those shorts. And in the case of shorting securities, you have to buy them. And so today was, I think, a tremendous amount of short covering off that bottom last night. And then a huge amount of bearishness, meaning lots of people holding cash, waking up and saying, wait a minute, maybe we don't want to be out of this market after all and buying it. The question mark is, will the rest of the world follow suit? Right now, Japan is rallying very hard this evening, and it won't surprise me to see emerging markets follow suit. Now I need to take a deep breath and say, this is all just one day. One day does not a trend make. It could be all positioning, and we could get that sell-off tomorrow. So folks, before we get too giddy, understand that markets can be very precarious. We have a Fed meeting December 14th to contend with. Right now, though, it looks like the doors have been opened to do some of the kinds of things that would lead to good returns in some of the areas that we've been stressing of late. Thank you as always for watching and listening, and of course I'll talk to you again very soon. Bye-bye.